Hello everyone, welcome to this first fixed income roundtable from Capital at Work. My name is Erwin de Seyn, I am the Chief Investment Officer of Capital at Work. In today's roundtable we will discuss concepts like duration, exposure to foreign currencies and being invested in inflation-linked bonds and corporate bonds. For this roundtable I am joined by my colleagues, Paul Smets, who is the head of fixed income, Christophe van Canet, our chief economist, and Pierre-Henri Augier, who is the head of our investment team in Luxembourg. Gentlemen, welcome.
Thank you, Owen.
Paul, let's start with you. Can you maybe give a comment on the current investment context for fixed income investors?
Well, yes. The current investment environment for fixed income investments has become much more appealing. Remember, we come from a period of low, even negative interest rates. Mid-2022, central banks started fighting inflation by hiking interest rates, by lowering their balance sheets. This led in the first place to a tremendous bear market, let's say over the past 3 to 4 years. But in the meantime, the current levels of interest rates have become quite appealing. For instance, the German 10-year Bund, the 10-year German sovereign, is at levels of about 2.70%. And the 10-year US Treasury, for instance, is slightly above 4% today. So these levels have become much more appealing than where they used to be, let's say, over the past 10 years, for instance.
Thank you, Paul. It's good that you point out effectively those two anchors, the 10-year US Treasury and the 10-year German government bond. Christophe, based on this environment, what do you see currently as the most attractive opportunities?
Well, as Paul said, we have higher interest rates in general, but we can even improve the performance by adding high-quality corporate bonds to our portfolio to pick up some extra yield. Another opportunity which we use extensively is investing in inflation-linked bonds. We are of the opinion that inflation remains more of a threat going forward than the market is interpreting right now, and so there is opportunity to invest in bonds which are related to inflation. One of the debates on which is raging at the moment is whether AI will be deflationary, so reduce inflation because it will improve productivity, or whether it will first create more inflation because necessary resources, especially electricity prices, will go up. And thirdly, we do also invest in other currencies than the euro, which gives us the possibility to diversify risk profiles and return opportunities.
Thank you, Christophe. So several pockets of value that you have identified, but when we talk about opportunities, we also need to talk about risks. Pierre-Henri, on the flip side, what do we need to monitor in today's environment as a fixed income investor?
Well, indeed, there are three main risks I think that we need to monitor today. Christophe just talked about inflation. I think that inflation is probably one of these risks. Inflation came down a lot since the post-COVID peak, but still it's sticky. It remains a little bit high. And it implies that central banks might need to keep their interest rate a little bit high as well, and that could put pressure, if it goes during a long period of time, it could put pressure on the bond price. That's one risk. Another risk is clearly coming from geopolitical uncertainties. You just have to open your television or newspaper, and every day you will hear about conflicts, election, trade tension, etc., and that could put pressure, well, on the level of interest rates, on the credit spread, but also on the currencies in which we are invested, and that's something we manage very closely. That's why we also have a very well diversified portfolio that is managed actively, and it allows us to adapt the composition of the portfolio to this changing environment. And last but not least, we also have the credit risk when we invest in bonds. Especially today, we monitor that credit risk in the IT sector because we see that things are moving quickly in that part of the world, because you have all these big IT players that are increasing a lot their level of debt to finance new projects, especially in data centers. It costs a lot of money, and this company needs to increase their debt, and it increase the level of risk. And that's also, of course, something we monitor very closely.
It's striking that when we talk about credit risk, that we continue to stress credit risk at the level of companies, but probably going forward for the next decade, the credit risk with regards to countries is probably something which is going to play an important role as well. And it's probably for that as well that we attach so much importance to the AAA credit ratings of countries like Norway and Australia. Duration, Paul, that's a term we often use within our discussions, but I guess it's not always clear for the average investor. Can you maybe explain it in your own simple words, please?
Well, yes, duration is one of the important risks that we manage. In fact, duration is the price sensitivity of bonds to changes in interest rates. For instance, when you have a 4-year duration and the interest rate of your bond with the 4-year duration rises by 1%, the value of this bond will decrease by about 4%. Okay, imagine you own a bond that has an 8-year duration and the interest rates rise once again by 1%. The price will probably reduce by about 8%. So the higher the duration, the higher the price sensitivity of your investment.
Paul, with the 4-year duration, we have a relatively short duration. What is the reasoning behind that?
Well, we do, in the current market environment, we do not really want to take this interest rate risk. So we have a duration slightly below 4 years even. So first of all, when, for instance, interest rates rise by, I already gave the level of magnitude. If interest rates rise by 1%, we don't want to have this more than a 4% decrease in values. So that's one thing. On the other hand, it offers the opportunity, because our average duration is below 4 years, that bonds will mature relatively more quickly, and this allows us to capture eventually these higher rates if they materialize. So for reinvestments at more appealing levels.
Thank you. Christophe, maybe a pivot to our currency exposure. We hedge a big part of our US dollar exposure. You read a lot about it in the newspapers. There is a consensus building around some pessimism around the US dollar. Of course, a currency is always a couple. It's not the dollar in isolation, it's against the euro, and we are not free of our own worries. But we are more specifically looking at some other currencies to diversify our risk. Can you maybe expose a little bit what we are doing there and why we are doing it?
Sure. Well, we can invest in different currency markets and in different bonds in different currencies, and that allows us to diversify the drivers of the performance. One prime example is, for example, that we can invest in currencies of economies who are a lot more sensitive to basic materials, to oil prices, and that you find, for example, in the Australian dollar and partly in the Norwegian krona, in which we are invested. Another possibility is that we look for better balance sheets. As you know, a lot of countries, among them the United States and some European countries, have quite a lot of debt. So we're looking for better debt profiles, which we find, for example, again, in Norway, one of the only countries which in fact has a net investment position as a government. And thirdly, we look to pick up some extra yields in currencies of which we think that, well, they are more than compensated for the risk profile they have for the moment. And that we find, for example, today in the Brazilian real and in some emerging market currencies, which in fact offer in relative terms better quality today than they used to do 10 years ago, and which still pay a decent interest rate compensation for that. So we have these three drivers, different risk profiles, better quality, and yield pickup to invest in different currencies.
Thank you, Christophe. When we think about the build out of our portfolio, the current setup, actually there's two big building blocks. There's 40% in inflation-linked bonds and 40% in corporate bonds. Pierre-Henri, can you explain a little bit more those two building blocks and why we give them such a huge weight in our portfolio?
Yes, sure. In fact, they have two different purposes. The inflation bonds, inflation-linked bonds, are there to protect the purchasing power of our clients and of the people who are invested in this portfolio. Why? How does it work? These bonds, their coupon is linked to inflation, and the price at which they are reimbursed is also linked to inflation. So it means that if you have inflation, when you are invested in that product, you are protected against inflation. So that's really the aim of this part of the portfolio, protection. On the other side, you cannot only have protection in the portfolio, you have to get some return. And that's why we use corporate bonds. It's because when you invest in corporate bonds, the main purpose, not the only purpose, but the main purpose is to try to catch higher return. And that's what we are doing. In addition of that, it allows us to improve the diversification of the portfolio.
And what concrete benefits, more specifically, do these categories offer? If I have it right, the inflation-linked bond proposition today offers our investors a 2% real yield with inflation. So the proposition is 2% with inflation. What is the proposition for the corporate bond investor these days? What kinds of yields are we talking about?
Well, you can probably add something around 1% more when you invest in corporate bonds. That's for the yield, depending on the currency. Of course, the yield pickup are not the same if you go in euro or if you go in US dollar. But the main interest is that when you combine both, in fact, you have a very good and very interesting mix between protection and performance. And in the market today, we are able to identify very high quality companies that offer interesting yield.
The current credit spreads are historically low. Is that also why we attach so much importance to the quality of the companies that we invest in via the corporate bonds?
Yes, of course, because if you are not well paid to take the risk, you have to identify a risk that really worth the return you want to have. And that's also why there is a lot of added value in our analyst team, where our colleagues try to find companies and analyze the balance sheet of these companies to make sure that we invest in high quality bonds where the return really is justified.
Gentlemen, thank you very much for these comments. I will try to wrap it up. So bonds today, again, offer steady income. Yields have risen a lot over the past few years. So for the first time in many years, we have some income there that we can expect. And thanks to that steady income, it will help to stabilize our portfolios in certain environments, investment environments. Thanks to our inflation-linked bonds, we also have the protection against purchasing power. And as all of you have very well explained, we are an active manager, which means that the currency exposure, the duration exposure, the mix between inflation-linked bonds and corporate bonds is something that we try to manage every day.